Time now for Hot Picks, and our focus today is on the biotech sector. Our next guest has been tracking these names for many years. Rahim is a portfolio manager and an options strategist at Next Edge Capital. Great to see you. We were talking in the break about how, as a sector, biotech, it takes a lot of legwork to get up to speed, and there's always moving parts. What's the first thing people have to think about when they're looking at the biotech sector?
Well, first of all, they're involved in developing treatments and cures for what has previously been untreatable. So they work at the level of synthesizing proteins in a way that regular other drugs don't really work. So they address the most chronic and acute ailments and often fatal ailments and rare diseases and so on. And so it's very complex. It's not homogeneous like other sectors. Every company has its own unique science. It's not one size fits all. And you have all these obstacles, clinical, regulatory, financing hurdles to overcome to get to the finish line.
And would it be advisable to people, if they're going to spend some time trying to understand the sector, to understand the rules of the game? Because a lot of times these are early stage companies in terms of the business portion.
Yeah.
It's not uncommon for them to be without profits because they're sort of working towards getting that product to market. So there's all these, trial dates, regulator approvals or lack of approvals that seem to result in lots of action in the stock. But that's a different move than company reports results, here's how they did versus what the expectations were.
Exactly right. So the process to develop a drug, you'll have to go through basically 4 phases: preclinical phase 1, 2, 3, before you get approval to commercialization. And there's a lot of drama along the way. And so markets look forward, they discount, and they burn a lot of capital. That's why they're basically a long duration asset, and they're very sensitive to interest rates, right? And so that is just part of it.
Interesting. So knowing the financing realities is good too. Okay, so that's a good backdrop for the 3 companies we're going to talk about today.
Yeah.
One is Legend Biotech, which I believe is LEGN.
That's correct.
In the U.S. Tell us about this company and why you've flagged this business.
Sure. I think Legend's one of the real hidden gems out there. So biotech has gone through this savage bear market over the past 4 years, down about 70%. But now, as you sort of wade through the rubble, you could find these great companies that are commercial or early commercial, de-risked, and that are going forward. Legend's one of them. So Legend has developed something called Carvykti, a drug that's partnered with J&J. It addresses multiple myeloma, which is basically a blood cancer that's a death sentence. They, however, are best in class. They've delivered 5-year data where 36% of the patients survive beyond 5 years. That's effectively a cure under these terms. If you've survived for something that is incurable or unsurvivable, you survive beyond 5 years. They're going to do $1 billion in revenues this year. There'll be $3 billion by the end of the decade, turn profitable next year. Stock's down 50% from where it was at its peak. It's gotten approval in 4th line and 2nd line multiple myeloma. A couple of years, we'll get 1st line. Huge market, substantially de-risked.
Interesting. So it's been having a nice run, but off a very low base. And
exactly.
A lot of Wall Street seems to like the stock now as well. So
yeah, because you have the transparency with J&J. So there's a certain amount of strength and partnership and distribution. But it's beautiful technology. It's part of this cutting edge technology where you're able to take away a patient's T cells, take it away, modify it, make it sensitive to your myeloma cancer, re-inject billions of cells back, and then your body develops an immunity against that cancer.
Okay. Appelis Pharmaceuticals is another company that you're watching.
Yeah.
How come?
So Appelis is down about 80% off its high, from 100 down to about 19. And they've taken 2 drugs to commercialization. One is Syfovre for geographic atrophy, and Empaveli for PNH, which is a rare blood disorder. But at the end of this month, they will highly likely to get approval on 2 more rare diseases. So they're down substantially because of competitive pressures on geographic atrophy drug. But you look out 3, 4, 5 years, their Empaveli is going to be $500 million, their Syfovre will be $1 billion, and these 2 other new indications get approval for is another $500 to $1 billion. So I think it's substantially de-risked at this level.
So the theme so far is stocks that have come off quite a drop.
Yes.
But in terms of the pipeline, not the drug pipeline, the revenue pipeline,
100%.
There's some good transparency there.
That's right. And so I think the risk reward is substantially skewed to the upside from these levels.
Okay. And then a third company, CYTK, this is Cytokinetics?
That's correct.
What are they all about?
So they are going to get approval on December 28th, I think, or December 26th is the PDUFA date for a drug called aficamten for a heart muscle disorder called HCM. Now, there's already a drug on the market by Bristol Myers called Camzyos, which, curiously, Cytokinetics also developed.
Okay.
It was partnered to a company, and then Bristol Myers bought them several years ago for, I don't know, $10 billion or something like that. It was incredible. Now, Cytokinetics is a real opportunity because it's a best-in-class. Aficamten's better. And the other thing is, it slipped up for two reasons. One is, so when they reported efficacious phase 3, stock went from 36 to 80s, and then Novartis was going to buy them at 110. Management spurned it, holding it for 140. Stock tumbled. That was compounded by a delay in their filing. So I think we know that Novartis was interested in them at $110 a share. It's floundering at 35 right now.
So I guess my follow-up on that, it's not necessarily Cytokinetics, but it is, I would imagine there is this temptation with some of these companies, if they're working on world-class treatments, and the largest pharma companies are always looking for the next drug, in their tool belt.
And they really need that right now.
And they do acquire a lot of these businesses. Yes. That there would be, an enticement on the part of investors to sort of be trying to game out whether or not this stock is an M&A target. Does that work? What's the sort of,
The hit rate is lower. Like, we're somewhat fortunate because over the past 10 years, we've had 18 of our companies acquired and 2 this year,
wow.
Mary, and one Canadian company, Thera Technologies as well. But that's because we tend to focus on late phase commercial companies, which is where the acquisitions tend to occur. It's not that we seek it, we just like good companies. It so happens that management likes to do it. However, the downside of that is sometimes you have great growth companies that just get taken out that, had they remained independent, would have been 10 baggers.
I see. And real quickly before I let you go, just if people heard you saying that we're coming off a bear market, what prompted the bear market in the industry to begin with?
So first of all, it was overvaluation, excess issuance back in the spring of 2021, and then that dramatic rise in interest rates. Being a long duration asset, it's been very bad for it. We culminated with this meltdown. So when the policy changes came and Trump put in new heads of FDA and RFK, so the day RFK was announced on a Friday, biotech got crushed 6%. And then that was followed up with guys like Veena Prasad and so on, which has been very negative for the sector. But it is a stock picking sector. It's not a rising tide that will lift all boats.